Hello, everybody. How's it going? This is Seth Williams and my co-host, Jaron Barnes. We're both here on behalf of the REtipster podcast. Today, we're talking with a couple fine young gentlemen. First one is Ben Leybovich. Ben is a veteran BiggerPockets member. He's been a massively successful real estate investor, an apartment syndicator. He's an author, a speaker, and a house hacker. We're also talking with his business partner, Sam Groom. Sam is a CPA. He's got a lot of good financial background. And Sam and Ben have been working together. I'm not sure how long now. I'm sure we'll dive into that. But they work together on a lot of projects, and they kind of complement each other in the ways that they get deals done. Ben, he's the founder of JustAskBenWhy.com, where he trains students in everything needed to be successful in buy and hold real estate, especially when it comes to the large apartment deals. So with that, Ben and Sam, welcome to the show. How you guys doing?
Great. Thanks for having us.
Awesome.
Pleasure to be with you.
Yeah,
man. So I want to start this conversation off. Guys, Ben's background is kind of out there. He's a classically trained musician. He was diagnosed with MS, needed to figure out an extra source of income that wasn't directly dependent on his hands, and that led him to real estate. So one of the things that I wanted to ask about your background, I wanted to narrow in on your specific type of real estate that you chose. I want to talk about why you decided to essentially master, become an expert in apartments, tenants, toilets, that whole mess. Why did you choose that instead of like triple net or storage unit or owner financing?
You know that saying, better lucky than good?
Yeah.
I think that pretty well described me. I tried single family. Well, let me take a step back. Traditional flipping, SFRs, that's just nothing but work. I was told by the doctors, hey, don't do that because we don't know how long you got until you're in the wheelchair and past that and, with the whole MS thing. So, maybe don't punch the clock. So I'm looking at everything like the scope of everything available and going like, okay, where and how can I make money that doesn't require a traditional punch the clock? Like I have to be there or nothing happens. So right away, I'm looking at the passivity of the activity that I'm considering. Well, basically nothing in real estate is passive, but some things are much less passive than others. Certainly things like flipping, things like wholesaling. I mean, wholesaling, anything to do with marketing and promotion, which really wholesaling has very little to do with real estate. Happens to be the asset class that's being moved, but mostly it's marketing. Okay, on both ends of that deal, you just market. So I didn't know how to do that first, and second, it wasn't passive. I mean, I was smart enough to figure out, hey, I got to be present to it. I got to put time into it, or nothing happens, right? So I figured I just looked at a building, looked at a fiveplex and said, hey, once I buy this thing, yeah, I got to manage it, but, they're paying monthly, and certainly on the surface, what did I know? For all I know, hey, this looks pretty promising. Not only that, but I quickly realized the essence of leverage, no money down financing, a lot. You put all that together and you go like, hey, I think I got a winner here. And now I just have to figure out how to be really good at it, because if I really want it to be more or less passive, if something happens to me and I get taken out, I don't want to leave my wife, stick this stuff to my wife that they have to manage, and it's unmanageable. So I have to figure out what kind of asset class I want to buy, what kind of apartments do I want to buy, what kind of tenants do I want to attract. All of that funnels into the passivity of the whole activity. So that's always been my MO. When I'm looking at 150 units, it's no different than when I'm looking at a fourplex. It's all a function of how passive is this thing going to get. Now, there's a repositioning process to get the thing onboarded and get the thing rolling, but past that point, how passive is it going to be? Aside from my personal need for it to be passive, there are very clear business implications. The more passive you can make this, the more stable it will be, the more profitable it will be. It's a function of lowering economic losses. It's a little bit in the weeds of real estate lingo, but it's all about passive. the more passive it can be, the more profitable it will be. And so it just kind of lined itself together, and I felt certain things intuitively at first. I couldn't really put numbers to them. I didn't know enough about real estate to analyze it, but intuitively I felt, hey, I got to buy the kind of assets that are going to be passive as much as possible. So hopefully that answers your question a little bit. There's much more to be said on the subject, but
yeah, man. So Sam, tell us a little bit about your background. I have lots of questions for you guys, but I want to give you an opportunity to kind of introduce the world to yourself. I mean, are you outside of doing, what you're doing with Ben right now? What's your background?
So I'm a CPA. And then a few years ago on the side, I started flipping. Flipped for about a year and a half. Left my career as a CPA, started doing that full time. And then I started investing passively into multifamily. And that's when Ben and I connected. Brandon Turner from BiggerPockets actually connected the two of us, knowing we had similar interests. And it's been about a year now that we partner together, and it's been great.
That's
hey,
awesome.
I think it's important that you tell them why you stepped back from flipping houses and first started investing passively in other people's syndications and then did this, because this basically backs my point, like the way I answered the first question. That's exactly what I'm talking about.
Right. So, I mean, flipping is a job. So I traded one job for another, something I enjoyed more. So you don't get a lot of the tax breaks, or any of the tax breaks that you would get for traditional investing. And you're trading your time for money. So I wanted to start investing the cash we were earning into other deals and creating passive cash flow in your traditional investing sense. So I started doing that. I found local syndicators. I did the crowdfunding websites. I was just investing in various places. That naturally transitioned me into, hey, I actually like multifamily a lot more. I'm more interested in it. I can use my background of a CPA. It just fits together with more of what my skill set was. So then I started looking at the sponsor side, and Ben and I connected, and it was just been a great partnership.
Here's a question that I have before we dive into a lot of stuff. What I was asking Ben, and I want to ask you your opinion too, Sam, like, do you guys feel that apartment buildings is the best asset class in real estate? Or do you think that it's a good one that you guys just gravitated towards and stuck with it and made it work?
Long term, I believe it's the best. It's the darling of commercial real estate. It's the one most investors can relate to, and everybody's probably lived in an apartment. They understand you're trading rent. When the market goes down, you have office. Office goes way down. All the small businesses that take up office space, they're no longer in business. Multifamily is just the one that is steady through. You can have maintain your cash flow through a market downturn. Usually, like in cities like Phoenix, rents don't go down when the market stalls out. You don't have growth, but you're still going to be able to pay your mortgage and go through any downturn. I just think, I think multifamily is the best real estate asset class.
So what I'm hearing there is that, first of all, it's something that everybody can relate to and everybody understands. And also, I guess the cash flow is more predictable, at least in the markets where things are going fine. Because I know, like in Michigan, rents definitely went down. There was huge vacancies. I know when I think about apartment buildings, it was actually something I was super interested in for a long time. But it was actually like, I think the reason I was because I didn't realize there were other things out there, things that people thought about a little bit less, but were pretty darn good from a cash flow angle. I mean, things like farmland, like self-storage units, like warehouses, things that, I mean, if it's in the right market, again, similar to apartment buildings, if it's in the right spot with good demand for it. I don't know if you guys had ever thought about that, or if there was a reason why apartments stuck out as like, that is the number one option.
We have thought about it, and we continue to think about it, and we continue to underwrite opportunities in other sectors. My answer, I think, would be a little different. Rents definitely go down in a down cycle, which is why you only buy value add, which is a whole another conversation. So what we would do, what Sam and I would do, is we would buy a building where we can improve the top line in today's market by 30 to 40%, which means that in a down cycle, we might lose some of that. But in the process of doing it, we're rehabbing. So we're going to be the best thing in the marketplace in that particular submarket, where our cost basis is such that we can still maintain and be very competitive, even if the rents should go down, if the economic vacancy should go up, things like that. first of all. Second of all, we would not consider for a split second to buy in Michigan or Indiana or Ohio or can I say
Well,
something?
go back to Indiana.
Or Chicago, right?
Indianapolis is the perfect market for multifamily. Going back to rent growth, I think they're at 30 plus years of continuous rent growth, not even stalling out, just 30 years of rent growth. So they didn't have a downturn in rents.
The same, I think, can be said in Columbus, Ohio. But you have those two markets in the Midwest, and I challenge you to find a third one that you could underwrite the same way as you could do Columbus and Indianapolis. So fair enough. So you have Columbus and Indianapolis, but mostly, my preference for apartments is a function, it's a need. People have to have a place to live. We've had home ownership rates go from 62, 63% to 69% before the crash in 2007. Then right now, we're still a little bit higher than that. So historically speaking, home ownership rates are still going to come down, but our population is growing. Specifically, if you go into a growth market, someplace in Texas, someplace in Phoenix, okay? You layer those things together, and apartments make a lot of sense. It's not the only thing that makes a lot of sense, but it's something that makes a lot of sense in this cycle.
And it makes sense where we are.
Correct. It makes sense where we are and with who we are. So our particular intellectual worth happens to fit with apartments very well. It's just what I know. So for me, it would be a question of, can I succeed with what I know using my intellectual worth? Or is the market so tough that I need to go somewhere else? And there's nothing wrong with either one of those solutions. It's just so happens that we're able to succeed still in this space. So we underwrite. In fact, from what I see, storage facilities are ridiculously expensive right now. I mean,
you can buy them though through owner financing. So
yeah, and same with mobile home parks.
They're underperforming assets a lot of times. Like 70% of the industry apparently is owned by mom and pop owners that haven't raised rents in like 10 years, 15 years. So there's a lot more discrepancy.
Yeah, and it's a similar thing to what you were saying, Ben, in terms of like the value add. Like that's kind of what you're looking for. Like if you can't get in there and change something to make it more valuable, then it might not be the best idea.
The only thing is I know that anything under about 500 to 700 units of storage units, I don't even want to look at because it's not worth my time. Because, it's like, whatever. I mean, 250 storage units. It's like, what? It's a mom and pop play. And then you get into the management and the passivity of the whole thing. And then if you're me, you're asking yourself, well, how much money do you want to work for? Because you're outsourcing everything. You're not going to manage this. I'm not going to manage this. Life's too short to manage storage units. So I'm sourcing this thing out, which means I'm paying payroll, this and that and the other. So how much is left for me, please? On 250 units, I'm not interested.
Management of a storage unit is a heck of a lot easier than an apartment building.
Oh,
what I'm telling you, Ben, is that you're dead wrong.
that was my question, though. Honestly, like, don't you have to pay for property management with an apartment building? Don't you have to have that in-house? It's a similar expense, right?
Yeah, it's probably a lot higher expense than it would be in storage units. And we're talking about different things here.
Well, there's professional managers in apartments too.
Right, we're paying payroll, right? So,
and management companies.
We're not interested in small deals. If we can't, if there's not enough money being moved around in a deal to validate and underwrite proper payroll and proper management infrastructure, we're just not interested in that deal. I got a call yesterday on a 60 unit. I didn't tell you, Sam, in Tempe, but I can't do anything with a 60 unit because there's not enough.
You should wholesale it.
Manage it.
There's a huge market for commercial wholesale properties. People, when I worked at Simple Wholesaling, everybody that was an out-of-state buyer was asking me, do you have multifamily? Do you have multifamily? I'll buy 10, 15, 20 units, 60 units. So that if you get leads like that, you could definitely capitalize. But again, it's a trading time for dollars thing, right? Because that's
this one was from a broker. And it's a national broker. So I don't know if you guys know how to direct market to apartment owners. In my experience, it doesn't work. In my experience, everything I've ever bought has been through a broker. Now, it might have been an off-market pocket listing where they didn't, it didn't go into the system. It didn't go into the MLS. It was done off the grid. But I don't really know how to write a yellow letter to an apartment complex owner with a $25 million apartment complex. I mean,
yeah, the only time I've ever heard it work was I was at a Collective Genius mastermind meeting, and I think it was Sean Terry and his business partner, that guy that used to be in a Christian rock band. I forget his name, but what they did is like it cost their mail pieces cost like $200. Like the things that they sent out, they only sent out like maybe $500 or 500 of them to very select apartment buildings because it had to be a very high like, hey, pay attention to me, I'm serious. So I don't think that mass mail at all in terms of marketing could work.
I had a question for you guys. When you're buying these apartments, are you like hanging on to them for a few years and then reselling them, or are you refinancing them and then holding them yourself long term? Like what's the long term play with that, and what are the pros and cons to both?
Well, since we buy them as a syndication, the whole holding it yourself and getting the investors out is off the table because you're basically asking your investors to forego the appreciated value in the apartment complex, right? So no investor is going to want to do that because there's a certain amount of risk involved with what we're doing. And so the reason people put money into these things is because they figure, okay, yeah, we have cash flow, but chances are because of the value add, the thing at the end is going to be worth a whole lot more than what we're paying for it. I want a piece of that. That's really why I'm stroking you a check for $100,000. Okay. So that whole thing that works on the debt side here, you have a private loan for $300,000, just pay me 8%, cash me out in 6 months through a refinance, and I'm happy with that. I don't want any equity. I don't want any risk that comes with equity. That doesn't work in this space where we operate right now. So we can't just simply refinance and give people their money back and ask them to be happy with that. So that's completely, as a strategy, that's off the table. As far as the hold period, we underwrite 10 years because we don't have a crystal ball and we don't know what the cycle is going to do. And part and parcel with that underwriting is projection of an exit for every single year during the hold period, because there are different strategies to get out. So for instance, we bought this building 3 months ago, and in another 3 months, all of the kind of exterior common areas are going to be done and probably about 20% of the units. Well, could we test the market whereby we're selling a still value add intact product, whereby we've proven the value add program, we've proven that it works, we're getting the rent. Here, the next guy, you can buy this and you can finish the rest of the 80% of the units, and here's your value add, and you can just, we've taken the risk off the table for you, and it's a proven program. So we could try to do that and get out in a year, maybe a year and a half, okay? Or we could try to get out in 3 years, or we could refinance and give our investors some money back and get out in 5 years or in 10 years, So it's a very moving target. Your question is right on the money because it's important, but the answer is a little more complex than saying, here we are, this is our rigid kind of plan, because the markets aren't rigid. And ultimately, you have to work with what you have in the marketplace. Is that pretty much it?
No, that helps. That makes a lot of sense. For those who don't know what syndications are, I know we've kind of been talking about it for a while now. Can you just give us a rundown of what is a syndication, and can you do this kind of thing with any type of real estate, or does it only work with apartment buildings?
Let's go with Sam's, just so that we hear from him as well.
Yeah.
Are you okay with that? I'm just kidding. So syndication is, it allows investors just to pull their money together and invest passively and have a manager of those funds perform the business plan for them. And to answer your question, it's not just multifamily. Any asset class in any business, you can have a syndication. So I was at last December, I believe, I was in a crowdfunding syndication conference in Vegas, and there was people doing medical marijuana in California using syndication. So it's
That's
just
hilarious.
yeah. So it spans any kind of business, any kind of real estate asset class.
Were they raising money for the business of medical marijuana, or were they actually doing marijuana while
It was actually both.
They were doing it. I'd like to know.
It was both. They were doing building warehouses and renting them out for the industry.
Fantastic business, by the way.
Yeah, and then also had a business in growing.
Yeah, I mean, there's a lot of money in that industry right now. It's kind of crazy. It's like the beginning of the tobacco industry all over again. In like 50 to 100 years, it's going to be interesting to see how that impacts culture. But
right.
going back to kind of your guys' strategy and syndications, it sounds like essentially the approach, it's kind of like flipping, but instead of actually flipping a single family house and managing contractors and being, super involved, you're taking a long-term approach, and you have this value add plan in place to take an underperforming apartment building, do some things to increase the income, and then flip it and sell it off in a few years.
Right.
Is that accurate?
That's exactly what we're doing at the core of it, right? Obviously, the dynamics are different. In single family, when you do a flip, you do a comparative market analysis and you determine your ARV after repaired value, and you work the numbers backwards. Where the newbies get in trouble is they say, I paid this for it, my holding costs are right here, plus my repair costs, plus my profit margin, I'm going to sell it for that. Well, that's wrong, because what you sell it for is a function of the market, not what you need. Therefore, the process starts with, what am I going to sell this thing for once it's perfect and it's done and I'm finished doing what I'm doing? Minus my costs, minus my profit margin. Mm-hmm. That's what I can afford to pay. That's my strike. Well, in essence, that's what we're doing. Of course, all of the dynamics are different. You start with the fact that value in multifamily somehow pegged to the income. So a function of repositioning and value add is a function of increasing the net operating income somehow. And then you have to, of course, establish an ARV. Well, how do you establish an ARV for 10 years from now? That's a very, very involved conversation that I have no intention of having on this podcast, but
that's what we pay you the big bucks for, right?
That's what makes it.
That's why you go to Phoenix at your live event in a few months from now, right?
That's right. We're having the Phoenix syndication workshop. Thank you for bringing that up. But that's the challenging part about this, right? When you push your time frame, it's hard enough to say what's going to happen 4 months from now. People in 2008 found that out, okay? But when you're talking about underwriting a hold for 10 years, how do you do it? But you have to, because in order to properly underwrite where your cash flows are going to stand, you got to understand how your exit is going to look.
Right.
So one way or the other, you have to project a lot of moving parts in order to arrive at that ARV. And of course, your minus expenses. Expenses are inside of the net operating income, because that's income minus operating costs. So all of the expenses are taken care of, minus your profit margin, and it becomes your flip. And now, of course, you have to discount your cash flows for the fact that you are holding it over a period of time. Cash flows depreciate the longer out they go, obviously, because that's a function of net present value and inflation and all the rest of that good stuff. So you underwrite to something called internal rate of return, and it's very simple to kind of conceptualize, very intricate to actually perform this type of analysis. But at the core of it, you're absolutely right. It is a flip. It's just a long-term flip. You're putting a lot of time and a lot of moving dynamics in the middle between the entrance and the exit. But you're still underwriting your exit, which at its core makes it a flip, because that's what you do in a flip. You're underwriting your exit.
So here's my question about the difference between apartment buildings versus flipping houses. So flipping houses, it's extremely active. It's like probably arguably the most active form of real estate investing that you can do. But apartment buildings, you guys say that it's predominantly passive. Everybody's branded apartment buildings as being predominantly passive. So how are you guys doing the value add? How are you guys, putting in the dollars and increasing the value without having that take a lot of your time? Do you guys, obviously it's probably outsourcing, but you still kind of have to manage contractors and property managers. Am I correct?
So we partnered with a very large property management company. They have 21,000 units under management. And then, so that tackles the management side of it. As far as the renovation, they have a construction arm. So we pay them a construction management fee of 5%. They manage all of the contractors, subcontractors. It's a little work to get started on the first one and figure out your scope of work, everything that we want to, all the finishes. And then we're approving the bids that they bring to us. But we're not dealing with any contractors ourselves. The construction management arm does that all for us. And that's the advantage of going with the larger units. When Ben said that he was approached by a 60 unit, yeah, we could flip it, but our property manager that we're working on this deal, they wouldn't do that for us. They're not going to do anything less than 100 units, right around there. So that's the advantage of staying large. You can work with someone like that.
The reason they wouldn't do that is because they know better. They know there's not enough money being circulated in the deal to underwrite the proper payroll, the proper cost to them. They got to make money. So you have to be of a certain size in the deal before it makes sense for a property manager with these type of systems and infrastructure to step in. And we need them because we're trying to make this as, not active as possible. And there's going to be inefficiencies, obviously. If I was buying this building myself and I wanted to manage those tenants and I wanted to put them in my buildium and I wanted to do all that, I've done that. I never want to do that again. I will spend a little more money before I ever do that again. That's done. I never want to manage a single tenant ever again. I don't care if it's apartment tenant or storage unit tenant. That's not what I do. I don't want to do ever anything like that again. I'm still doing it. I still have my own portfolio. Once I get out of that, I never want to do that again.
So you're saying you do want to do that again, or you don't want to do it again?
I do not want to do it again. I do not want to ever.
Are you sure? Are you sure?
I don't want to be a landlord.
Are you sure?
I'm a syndicator. I just don't want to be a landlord. There's a distinction in those two.
Yeah, I think Seth was just being sarcastic.
I'm just
no, I understand, but your audience, they need to know, like, when you first step your foot into this game, you have to do certain things. And you must do it to gain perspective and to gain certain operational knowledge so that you can then remove yourself out of that equation and pay somebody else to do it, but you know what's being done and how it's being done, so you have control ultimately over what's going on.
That is kind of an interesting concept. I've heard that same kind of thing. I think I've even said that same kind of thing about like the land business and lots of other stuff. This idea that in order to be old and wise, you must first be young and stupid. Like you sort of
man, that should be a t-shirt.
You sort of have to like play that game of doing things the hard way before you can appreciate the easier way, or just like know what's the wrong way so you can not do it anymore.
I'm gonna pimp Sam a little bit here because he's the only guy I know who didn't do it. So his CPA background is such that, and I think he'll tell you, he started looking at those 15, 20, 24 unit buildings, and he started doing the numbers, and he came, I think, to a realization, the same one. I did it in the School of Hard Knocks. He did it because he understands numbers to such a heightened extent that he was looking at those numbers. It didn't make sense. He said, that doesn't add up. That's not, I'm already flipping houses. I don't want to be working. Now I'm going to trade this job of flipping houses for a job of managing 24 leaky toilets. That doesn't work for me, right? I mean,
I want to push you guys. I want to push back a little bit because I really like apartments and I really respect what you guys do. I've been following you for years, so when I do this, I am not being disrespectful at all. But I'm just asking a question. If we talk about apartments being an asset class that is passive, but your passiveness, the route to being passive is outsourcing everything, then I could outsource everything in a flip business, in a land business, in a wholesale business. I can essentially learn how to outsource businesses regardless if they're of the asset class. Right. So if we talk about apartment buildings being a truly passive asset class, and we take that factor out, what the model by which you guys are actually making money from apartments is a lot of work. It's just you're hiring somebody and putting an infrastructure in place where that doesn't personally affect you. But if you compare that to something like a parking garage, commercial parking garage, after you actually set up everything, you still have to outsource something, but there's less things you have to actually put in place than with an apartment building.
What we like about the apartments is there's a professional management company that I can go to that can handle all of that.
Yeah, they're actually worth their salt.
Yeah, and if you're flipping, yeah, you can outsource a lot, but you're doing a lot of babysitting too on who the people you're outsourcing to.
Potentially, unless you're good at it. Yeah. And if you develop that skill, yeah.
And let me tell you something else. You know, I haven't seen an inside of one of my Lima, Ohio units in years. I have a guy that I trust. He knows more than I do about who's living there, why. I do the qualifying. It's all done via Buildium. The payment portal is in Buildium. It's about as passive as you can get. But at the end of the day, I don't want to do that anymore.
Yeah.
Like, I don't want to get a call that there's a leaky toilet ever again.
Yeah, that makes sense.
Now, the property management infrastructure is very, very different for these other asset classes. There's no accepted norms of how you manage storage facilities. Of course, you can build systems, and you should if you're going to be in that business. But you are managing directly the guy that's on your payroll that's sitting there and getting an apartment that's on the property or a house or whatever. I know how that works. I just don't want to do that.
With apartments, the biggest incentive to go into that asset class is that there's an industry of very professional property managers that you can just hire and just be done with, versus property managers in the single family or smaller apartment, more mom and pop world. Property managers are not worth their salt, really. It's hard to come by a good one.
I've written so many articles on BiggerPockets and elsewhere over the years that say you cannot afford property management. Like, if you've got 60 units spread out between these small multifamily, you cannot afford professional property management. I'm not telling you you can't have a very nice life and live well managing these yourself. I'm simply saying that a truly professional property management infrastructure involving an office personnel on payroll, maintenance personnel on payroll, reporting arm, the accounting department, construction department, involving all of those things. Of course, you're going to pay for them, but that's what professional management looks like. And it takes a certain magnitude of asset class before you can afford all that, before all that starts making sense. Anything prior to that, you are doing it yourself. And it may be a good job. And it may be much more passive than showing up at a factory and pushing the red button. In fact, it is. If you buy the right kind of assets that attract the right kind of stable tenant base, that have enough money to fix the alternator in their car if it breaks down and still pay your rent. If you buy in the right locations, if you don't buy flat roofs in the middle of Michigan where you know you're going to have nothing but issues with a flat roof in the middle of Michigan, it's like, if you buy the right kind of stuff, and that's what I did, and that's what I've been teaching people for a decade. But at this point, I did that. I don't want to do that anymore.
Right.
I managed it. I figured out how to make it as manageable as possible. I figured it out by making mistakes and buying some things that are not manageable, and you shouldn't have bought them, but you bought them, and now you learned. Going forward, I don't want to do that anymore. And so I have to be in an asset class that is denominated in tens of millions of dollars, because that's where you have to be to afford a professional management infrastructure, which allows Sam and I to communicate to the manager.
I want to switch gears a little bit. And Sam, if you, I'm not sure your background, maybe you're in the same camp too, but something that I know you have in common with us, Ben, is that you have a course, an educational real estate investing course. And, being very involved with the whole BiggerPockets community, I'm sure you're familiar with the whole concept of like bashing the so-called real estate guru. Like, basically anybody who's selling anything about real estate in the form of a course that costs more than
or a live event. This might be a good time.
Or a live event.
It's
kind of just like evil. Like it's wrong to do that. Like you're somehow not legitimate, or there's something sleazy going on if you're trying to sell any kind of information about real estate. I'd be curious to hear your take on that. Like, is that wrong? Like, is there legitimacy to that? Like, how do you define real estate guru exactly?
Versus like a professional educator,
Yeah.
Well, and I've been very vocal on BiggerPockets and elsewhere. Education shouldn't be free. Anything that's free is lacking perceived value. And so it's like apartments. If you are in a town where rents range between $450 and $1,200, if you keep buying those $450 rentals, guess who you're attracting? And guess how easy or difficult your management of this tenant base will be. Well, if you want information, here's your rent. You got to pay something over here. It's free over here. That math ain't so hard. So I've been pretty vocal on BiggerPockets with Brandon Turner, with everybody. Now, somehow rather, because I don't charge very much. So I have a course that I charge a couple of $100s for. And in my mind, that's fair. Charging much more for it wouldn't be fair, because all that it is, it's not a discovery of anything new. All that my course is it's meant to shorten somebody's learning curve. It is a very concise, well-organized thing with some maybe of my perspective from my experience that's maybe less common, okay? But by and large, it's better than a book, more interactive than a book. But I'm not opening any kind of new worlds to Paris all over again. There's no new world being discovered in real estate. Real estate's been around for a while. That's always been my thing. Now we get into the Phoenix syndication workshop that Sam and I are doing, and the cheapest ticket is $1,500. Here's the thing. If you want to know how to make 6 figures on the deal when you close it and 7 figures on the deal when you sell it, that is valuable content. We have nothing to upsell. On my website, justaskbenwhy.com, I sell one course, CFFU. There's never been any upsell. There's never going to be any upsell. I'm not trying to, I do some consulting on the side, which is a separate item. But as far as courses, I have one course. Here's the price. It's a one-time price. There's no upsell. There you go. This is what you pay. This is what you get. Download it right away. It's right there, okay? Now, then you go and you talk about syndication. And you talk about this black box that there's no information, no good information, actionable information about how you underwrite these things, how you think about these things, how you put these things together. For me, it took years and years of study. If you think I'm going to give it out for a couple of $100, you're nuts. Specifically because I'm not trying to register you for a $20,000 program, mentorship program, or some crap like that once I get you there. No, we're going to charge you what we think is fair. And by the way, very fair, because about 10% of what these other guys charge you, and they don't deliver.
I think that's what distinguishes us between like the gurus. When you asked earlier, what's a guru? I think they get you into the door for $0 to $200. You go to a big event, you get pumped up, and you really get nothing out of it besides upsell the entire time to sell you on the $20,000 coaching package.
So, well, I have a question there. So sometimes though, human beings are stupid despite themselves. And sometimes, like, if you have something for the world that is actually life-changing, like you have the ability to give them something that is really going to deliver, but in order for them to be motivated, for them to actually take the plunge, do the work, you use some of these marketing tactics that some of the gurus use, like the upsells and the things like that, and even the psychological sales tactics, right? Like if you're convincing people, if you're selling people on something that is actually going to serve them in the end, whether they know it or not, is it necessarily quote unquote guru-ish, or is that going into like kind of black hat area?
No, it's not black hat. You don't eat if you don't sell. If somebody on BiggerPockets wants to argue me on that, I will argue them on that all day long.
I agree with you, 100%.
Okay?
Yeah.
And I'm not going to apologize for that. I get a lot of latitude on BiggerPockets. And this is because, and of course, when we have this conversation, we're talking about BiggerPockets. That's a big gorilla in the space, right?
Yeah.
And the reason I get a pass on a lot of this stuff is because of how much I've contributed over the last 6, 7, 8 years to BiggerPockets, both in terms of podcasts and articles and comments and everything else. So it's not like I'm of this mind where I won't give you any value unless you give me money. No, I'll give you value. And if you want to spend the next 3 years trying to piece this stuff together, be my guest. You probably can. But if you want to spend a little money today so that you can leave this course or this event having a really good idea of what's going on and having that leg up on your competition, you're buying my time, dude.
Yeah, I agree, man.
I'm a busy guy, and my time is worth something. And that's the other differentiator. You know, we're charging $1,500. We're actually going to be there teaching. So they're paying for my time. My course is a couple of $100. It's fully automated. It's nothing to me. I'm more than happy to help.
I think for me, the beef that I have is that, I guess it's not even a beef. It's just it's a point of confusion or just a frustration, is that a lot of times when I hear this conversation, everybody seems to have this different definition in their mind of what it means to be one of these sleazy gurus. And even that name guru, like sometimes...
Yeah, when did that become a bad context?
Well, I mean,
right?
sometimes it's a compliment, sometimes it's an insult. And,
right.
you know, sometimes I hear it referred to like as price points. Like there's this invisible line. Once you start charging over that, then you're one of these people. But once you're below that, then it's okay. Or if it's a book, that's all right. If it's a course, that's wrong.
Oh, no.
or things like does it have more to do with the sales tactics? Like if you're asking people,
Yeah, I think that's what it is.
Or, yeah, I mean, I don't know. There's just there's all these moving pieces, and nobody really has that clear of a definition on it. Like I've also heard people say, like, if you're making more money from selling courses than you are from actually doing real estate deals, then you're a guru. And if that's the case, I mean, I'll tell you right now, Josh Dorkin's a guru. And I'm not saying he's a guru, but by that definition, he would be. So
Right.
But,
I don't know. It's just like, how is it actually defined? And
so that brings us into a very interesting discussion, which is all about positioning. Josh Dorkin, maybe
Freudian slip.
but he is a very smart sales professional who has been able to convince his audience that he's not a guru. Now, could you say that about me? Probably, to a certain extent, because all of this energy builds up to a certain place, and I don't think, you know, most people who know me on BiggerPockets wouldn't call me a guru, even though I'm selling a product for $1,500, $2,000.
I agree.
I worked hard to position myself that way, but the way I did it is by delivering value for free for many years. The same can be applied to Josh Dorkin. A lot of people have benefited from BiggerPockets. That's a fact.
100%.
That's
Yeah.
not a fact that we can dispute. Simply put, a lot of people, newbies specifically, have benefited from BiggerPockets. And that's real. And that's what makes him a non-guru.
I've been hanging out with this guy. He's a marketing guy named Perry Marshall. And he's definitely in the entire, like, what BiggerPockets calls the guru world, like that's the world that he lives and breathes in. And hanging out with him, people that go to his events, they spend $25,000 a year for his high-level mastermind group. They'll spend up to $10,000 for a 2-day conference. But when they go there, like, they are actually getting tactical strategies that will make them at least 4x, 2x, 3x, 4x their money, their investment. Like literally a part of his package is like you buy, the roundtable membership, and within the first 90 days, they meet with you and they strategize on how they can make your investment back as soon as humanly possible. So I understand that like he might be a different class, and maybe really where the issue is when people are using the marketing tactics to not deliver, but just rip off a bunch of people. Maybe that's really where the line is. But I think in certain contexts, like if I had $30,000 or $50,000 to buy into an apartment syndication course that by the end of it, I'd actually have my first deal done, I'd pay that. I have other money going in other investments and things, and I kind of like storage units. But if that was something that I wanted to do, if the value was there, I think that it's justifiable to spend that kind of money, especially with, wealthier people. You talk about the 80-20 principle, top performers have money.
And that's the problem. It's the value's there. So in your friend, it sounds like the value's there. I've seen gurus where they charge $20,000 and here's access to 16 video courses of mine and I'll give you one phone call. And that wasn't the expectation that they set out up front in their free seminar that they had.
Seth, I struggled with this for a while because I created a course. Obviously, I want to sell it to as many people as possible. I want to help people, but I also want to help myself and my family. I struggled with the whole guru thing. It's a difficult thing, right? You have to believe that what you are offering is powerful enough so somebody can really do something with that to recapture that investment and then some. So you go back to my course. It's a course I created based on my experience a while back. Is there still value in it? Absolutely. Would I charge more than a few $100s for it, knowing that 99 out of 100 people will never do a thing with it?
I mean, that doesn't make it less valuable just because some people won't do it. I mean, for somebody who actually executes.
Put another perspective on it now. Now we're doing an event. Why are we charging so much money? Because I want specific kind of audience there. Okay? I want people who, A, have the capacity to spend a couple $1,000s, B, value their education enough to choose to spend a couple $1,000s, C, can build a relationship with me whereby it can result in a partnership, or it can result in them participating in a deal I do, or it can result in them bringing me a deal, or whatever. But there are so many value centers in what Sam and I are doing in January to where I have no qualms whatsoever. In fact, I think we're undercharging. And guess what? The people that are so far showing up, a lot of them have already purchased my course. Some of them purchased it 6 months ago. Others purchased 8 years ago.
Yeah, the value's there.
Yeah.
There you go. There's definitely a friction. There's always been a friction. There's always going to be a friction because you and I, we believe that knowledge should not be free. We paid for it.
Yeah.
It cost us dearly in a lot of cases to know what we know. Why anybody would think that me telling you everything I know should be free, whereas it cost me an arm and a freaking leg, is a ludicrous proposition. I don't think it's fair. I don't think it's a fair exchange. I'm all about fair. I don't want to abuse you. I just want it to be fair exchange. And I don't think me giving you everything I paid for with my skin for free is fair. You're abusing me at that point. That said, though, then there's the back end of it. I don't think it's fair to underpromise and overdeliver.
Yeah.
And that, I think, is what BiggerPockets attacks.
Mm-hmm. Yeah.
Everybody there knows I underpromise, undercharge, and overdeliver. Mm-hmm. And that's why I get away with being a guru on BiggerPockets.
Well, let's at the end of every podcast, we ask 5 standard questions of our guests. So I'm going to ask those of each of you, and you guys can let us know your thoughts, okay? So the first question is, what is the single most impactful principle you've used in your life or your business? Ben, you go first.
Exponential thought and exponential growth. You can grow linearly or you can grow exponentially. And I think what I found, and this is based on, he just passed away. I just went to Ohio to visit him like 3 days before he passed away. I had a partner and a mentor. He was an older gentleman. I learned a lot of things from him, but one of the things, his name's Ted, one of the things I learned from him was, if you make sure that each step you make is bigger and better, then that will guarantee your growth. That is the essence of growth. And so I had a choice. I could continue buying duplexes, fourplexes, 10plexes, and I could be that guy doing that. But I looked at myself in the mirror and I said, am I that guy? Am I going to be happy being that guy for the next 20 years? I could do very well. Thing is, I'm not happy being that guy. So I want 100 units. I want 200 units. I want exponential growth. That is a very, very powerful thing. It's like that curve bell where Model T and Tesla right now is experiencing that. Just about the right up there. And it took me a decade to kind of do this and grow like this and grow like that. And then boom, I just stopped and clicked. And that's been a very powerful concept for me, exponential growth.
Cool, man. Sam, what's your take on that?
My advice would be is basically how to get that exponential growth. And it's don't try to do everything yourself. Use professionals as much as possible. So we talked a lot about the professional management, but even just the process of closing a deal. So using a mortgage broker, using closing attorneys, just as much as you can, use someone whose job is to make you successful. A mortgage broker, they're going to guarantee or practically guarantee that loan closes because they don't going to get paid, and their time's going to be wasted if they don't close it. So just use people in your life that can help you succeed, and you don't have to try to do everything yourself. And I just think you'll be able to grow a lot faster and exponentially that way.
I think partnership is part of that.
Yeah.
Coming back to the earlier conversation we were having, there are a lot of things I am, but there are some things I'm not. But he is those things I'm not. And so that's what makes it do that.
Mm-hmm. Cool, man.
That's awesome. So I'm going to start with Sam first, and then I'll go to Ben. What is the biggest life lesson that you've learned from a mistake or failure? And you can't say becoming Ben's partner.
I think I waited too long to get started. Being a CPA and being conservative, and you want to understand every aspect of it before you jump in, and at some point you just have to pull the trigger. And we just saw one of the greatest downturns that any of us are ever going to see, and it would have been nice to start earlier in that downturn and get some of the extra bump that a lot of people got if you started in between 2009 and 2012.
So get started faster. That's awesome. What about you, Ben?
Mine is going to be a very long conversation, potentially, but don't focus on the cash flow 100%. Understand sooner that cash flow is a means to an end, but wealth is generated on the balance sheet. It's generated with equity. My focus for many, many years has been cash flow, and it's understandable. I was told I have MS. I didn't care about being rich. I cared about my family being okay if I get taken out by this disease. So what I needed was income. What I needed was cash flow. And I was so laser focused on the cash flow that I completely neglected the necessity of being in a marketplace that is a growth marketplace. So I could have gone about 10 times as far by now if I did what I did someplace better.
What is your biggest pain point in business right now? What do you think is the most viable solution for dealing with that?
I don't have any pain point. I mean, I don't mean it to sound just like I'm thinking about it, and I don't know.
So my life is perfect, man. Yeah. That's why you bought my course for $19.99.
I have a partner whom I love, and I love working with him. I have relocated my family to Arizona, where we have a wonderful home, which happens to be a house hack. which makes money. My wife has found herself as a real estate agent, and she's doing fantastic business and making very good money, and about to buy her own Tesla. As of last night, I caught her looking at Tesla website saying she's
It's the
about
standard
to
of success is once you own a Tesla, then you've made it.
Hey man, that's definitely in my
well,
book.
she sat there and she reviewed, and I was I was working on a funnel. I was writing an email funnel last night. She's sitting next to me on a laptop, and I'm seeing her. She's got pulled up an Audi, she's got Mercedes-Benz, BMW, and Tesla. And I say, so what do you think? He says, there's just nothing. I mean, what's the point?
I'll tell you, every time I walk into my garage and see my car, it's a constant reminder of how unsuccessful I am. I've really missed the mark in a big way.
Listen, the car stands for something. If it's just a car that's expensive, that's just BS. Because how small-minded can you get? The reason I drive a Tesla is because when I get into it, it makes me feel certain things about things in life and how I want things in my life. It's a measure of something much bigger than anything that has to do with money. It's got nothing to do with money.
Have you heard of Rabbi Daniel Lapin? One of the most impactful books that I've read this last year is called Thou Shalt Prosper. And it talks in depth about how money is not materialistic. Money is actually spiritual in nature. And I actually can understand where you're coming from, because when you buy an expensive car like that, it has nothing to do with the tires and the thing. It has to do with what it represents. It's the metaphysical representation.
That's exactly it. Listen, I'll tell you how that whole thing happened if you have a second, because it kind of fits with this conversation. I was still in Ohio, and I, at some point, decided I wanted a Tesla. It was just like this nagging thing. So I went down to Cincinnati. I was living in Lima, Ohio. Went down to Cincinnati. Met a guy, drove a Tesla, put in a deposit for a used Tesla, went back home, got an electrician to wire my garage. In the next 2-3 weeks, all of my businesses just flatlined, just like sales stopped. All of my cash flows just kind of slowed down to a point where I backed out of the Tesla. I just chickened out, frankly. I got depressed. Because for a guy, for an entrepreneur, when you know what you want and you know why you want it, for you to fold like a cheap wet towel like this, it's depressing as all get up.
Yeah.
You just don't know what to even do with yourself, what box to even put it in. So a month goes by. Every time I would go into my garage, I would see the freaking outlet wired in my garage for a Tesla. And I just backed out of a Tesla on a used Tesla. But that was the space I found myself in. So my wife says to me, this is a 107-pound Mack truck of a girl who is 4'9" or whatever it is, 107 pounds, but you better get out of the way because it's going to run over you if you are not careful. That's my wife. So she says to me, I got us a room in Cincinnati for next weekend. I got a babysitter for the kids. We're going and we're going to test drive the car because I want to know what's with your head so bad. That's a conversation that really happened. Okay, so I wanted to do it justice. So we went and we drove. I got in the front. The Tesla guy got in next to me in the front seat. Patricia sat in the back. She had a cup of coffee like that. And what they do is they take you about a couple of miles this way, then they turn around, they let the second person drive. So Patricia sat in the back, and 20 minutes into my drive, she says, Ben, I can see a smile in the back of your head. So she turned around. She drove on the way back. And when we got there, back to the Tesla showroom, she says to me, I get it. This isn't a car. This is what it took to take it from the audacity to imagine this is possible. Yeah. And then from paper to reality. This is the best looking thing. It's the best driving thing. It's the best for the environment thing. It's excellence personified. And you want this in your life, and you just backed away from it. So here's what we're going to do. We're making a deposit on a new Tesla. Go design it exactly the way you want it. You'll figure out how to pay for it.
That encompasses how all of the really, really, really wealthy people that I've had conversations with, that's how they think. What you just described is the main divide between the middle class and the rich. is that the rich think
Sure.
that.
Yeah, I had a very, very similar conversation with my wife. It almost followed that same storyline, but every time you said the word Tesla, replace that with bicycle, and that was what it was like for me.
You gotta set some
And
higher goals,
I've got
dude.
that bicycle with training wheels and everything in my garage right now.
That's awesome.
I get it, Ben. Totally understand.
But I mean, first of all, it's nice to have a wife who gets you, right?
Yeah.
That's not any kind of small
Yeah,
thing.
I don't know if my wife would be. Actually, now we're having this conversation. I'm like, if I was like, baby, I've arrived in life. It's time for a Tesla. She'd be like, dude, you're tripping. Next question for you guys. If you could know the absolute and total truth to one question, what question would you ask? We'll start with Sam.
Oh, that's easy. When is the market going to go up and when is it going to go down?
Yes, that would be amazing. What about you, Ben?
I have kids, so really I just want them to be healthy and happy. So if I could ask God the question, are my kids going to be well, and receive a positive answer to that, that would be all I want, because all the rest of it I can buy with money.
Yeah.
And I can make more money. That is really the only thing that's really of any kind of importance.
Sometimes I wonder about that, and it's almost like, man, I don't even know if I want the truth. Like, if the answer isn't what I want it to be, like, maybe I don't
Totally.
even want to ask the question.
That's why you don't ask the question. That's right.
I hear you, man. I get it. What is the most interesting thing you guys have read or seen in the past month?
Who's got time to read?
Hey, I make time to read. I love reading.
I got on a kick about a year and a half ago thinking I was going to read like 30 books. And I signed up for Audible and the whole shebang. And about 5 books into it, I said, screw it. I'm just like a bunch of information that I will never do anything with. I don't have a good answer to that question. There's a set of books I come back to. They're all mindset books. None of them are technical books, but there's nothing new in them. It's not like I read something mind-shattering in the past 6 months.
What's your top one of those books that you refer back to then? You say Rich Dad, Poor Dad. I am never letting you on this show ever again, by the way.
William Nickerson wrote a book, How I Turned, I think it was $5,000 into $1 million.
Yeah, I've got that book. It was written like in the 60s or something, and I had to pay like $60 to get an original copy. It was like really expensive.
I don't think they republish it. I found it in the library a long, long time ago. And as a mindset and as a very 20,000 feet in the air roadmap of how real estate works, it's a brilliant book. Absolutely brilliant book. There's others I like, but they're all very kind of broad strokey. Nothing like, here's the technique, here's how you do it, that kind of mathematical stuff. I gotta
say, I was surprised that you weren't gonna name drop Brandon Turner's books, because you guys got like the world's historic bromance. I think it's the longest running bromance in history. You guys should.
I read his books before they get published.
It's like you guys should apply for the Guinness World Record or Guinness World Record of longest bromance.
You know,
ever.
it's funny.
They just went to Hawaii together.
I know.
Yeah, we were just hanging out in Hawaii with Darren Sager. And one of the questions you guys asked me, what is the one thing that you would like to recommend? And I told you about exponentiality. We talked a lot about that. And he is, and I have to give him credit, he is like got a knack like nobody for creating new terminology. Okay. Yeah. House hack. That's people been doing it.
Yeah, I was talking to Scott Trench about that yesterday. Like Brandon's hands down pretty much made probably at least 20% of the modern real estate lingo.
Wait, did Brandon invent the term house hacking?
Yeah.
Are you serious? I didn't know that.
Yeah.
That's
kind of a big deal.
That's his. And he told me now he invented the next term, which was interesting, stacking. Yeah, so it's the opposite of linear. He's talking about stacking. And it came up in the conversation because we started talking. He realizes this also. It's like this parallel growth with all of us. We started around the same time and we're internalizing stuff and we're growing and coming to the same kind of realizations. And he said, we did a couple of live shows on Facebook, and somebody asked, what would you do different? And his answer was, I wouldn't do the same thing so many times over. I would realize the power of stacking. And in this case, we're talking about intellectual worth. Once you internalize what you need to internalize here, why are you going to keep doing it? You go and you grow because success and money is a function of stepping onto the next step in that ladder, intellectually speaking. And that's really what stacking is about.
What about you, Sam?
I saw a quote about a week ago, and it kind of explains what Brandon just realized when you're talking about how he changed his mindset. And it was a good judgment comes from experience, and experience comes from poor judgment. You kind of have to go through the growing pains to be able to get to where you want to be.
And coming back to our courses, all we're doing is we're saying, hey, you don't have to go through that because we did.
You guys did it, yeah.
Here's at least a baseline of stuff that you shouldn't need to do.
If the majority of the people in the world are willing to spend upwards of 50 to 100K in student loan debt, why would anybody have a problem to drop 25K on a program if it will actually get you to making lots and lots of money?
Yeah. In my partnership with Ben, I kind of just bypassed the whole experience and poor judgment. Just said, hey, I have a good enough judgment to just partner with someone who went through that.
That whole comparison between like student debt versus self-education or learning from courses and that kind of thing. I think the total cost of my college was close to a couple $100,000, something like that. And the total amount I've spent on courses is like pretty much less than 10 grand altogether for like everything I've ever bought. And like the courses, that's what's feeding my family today. It's not my college experience.
I totally agree. We've bought courses. I've bought courses. We've all bought courses. And it's like, if you're smart, that if you're spending $1,000, you're going to get $10, $15 worth of information. But it's the kind of information that you're going to turn into $1 million if you know what you're doing.
Yeah, for sure. So as we wrap this up, both of you guys, Ben and Sam, what's the best way for people to learn more about you, or if they want to get a hold of you for anything like that, how can they find you?
I'm at whitehavencapital.com, and I'm also at BiggerPockets.
And I am at justaskbenwhy.com.
And that's WHY.
Correct.
Why, Ben? Can you tell me why?
Well, we explore some of it here for an hour and a half. Hopefully we got to a little bit of a...
Do people ever email you and just say, why?
Why?
No, but every time he gives out his email address, like bankers or whoever it is, they always want to know why.
That's awesome.
Well, the bankers, dude. You can count on the bankers to give you hell. My email is ben@justaskbenwhy.com. And I do want to plug the Phoenix Syndication Workshop on January 25th and 26th. Very, very intense event. We're going to spend the first day. I've got 8 hours set aside for nothing but numbers. We're going to walk through the entire underwriting methodology, the process, everything else. We've got a property tour on the second day. We're going to have some speakers on the second day, professional people.
Cool.
That's awesome.
Oh, and the cool thing is we're donating 20% of our gross income to nonprofit. That's another interesting thing here. We've been talking about how, like Jaron and I talked about yesterday, how Rich Dad talks about, hey, if you have a doodad you want, buy an asset right here. It makes money. You buy a doodad with that money, so now you can afford it. House hack, all it is you're looking at this doodad, you're saying, I want it. But instead of saying, which asset can I buy? You're saying, how can I take this doodad that I want and convert it into its own asset? Mm-hmm. So it on itself makes money that it can pay for itself, and now I can afford it. That's basically your house hack. Well, I sat down, and maybe this is a function of maybe achieving a little bit of success, but you want to give back, but it still hurts to stroke those chicks, right? There's only so much that you can do to donate to charity and not profit. So I sat down and I thought, how can I create a business structure which encompasses my charitable giving, so that the more money I make, the more money the charity makes, and it takes care of my charitable giving, because there's no conflict of interest. I am interested in making more money, so I'll do what I have to do to make more money. And as a default side effect of that, the charity is going to make money. So we incorporated, Sam and I, a profit margin for the nonprofit, for the charitable giving, into the business structure of this event. So this is not a 20% of net. This is 20% of gross income that's coming in. We've got probably about 40 registrations right now, 30, 40, I don't even know. But we rented a space for 150 people. So that's gives us about a month and a half to fill the space with people interested in really taking a deep, deep dive into syndication, multifamily, understanding how the fundraising works, how the underwriting works, what all is involved, how the partnership structures work, all that.
If this episode happens to air before the blog post on house hacking goes live, the reference that Ben made about the interview yesterday is going to be on that blog post. And in the future, when that's posted, we'll go ahead and link it in the show notes. Hopefully I'll remember.
Yeah, the show notes are at retipster.com/32. That's 32. And you can find links to all this stuff, to both of these guys' websites, and maybe even the blog post that Jaron just referenced there. So thanks again, Ben and Sam. Appreciate your time, guys. And to the listeners out there, check them both out. They got some great stuff going on. And we'll talk to you guys next time.
Thanks for having us.
Thanks for having us.